everyone. Welcome to the fifth and final day of our annual Model Portfolio Review Week. I want to give the audience a few more seconds to get kind of settled. I see some people still joining us. So first off, I want to ask our audience if we have any SSR portfolio holders here. If so, we'd love to hear how many stocks in the portfolio you're currently holding. So you can feel free to share via the question section of your GoToWebinar control panel. And then also, since today is the final day of our webinar week, I'd love to know which other events you joined earlier this week. So you can share that via the chat as well. Love to hear.
Yeah, I'm also curious if you do follow the Stock Superstars report, do you tend to invest across all four approaches, or do you prefer to cherry pick with an approach that really kind of rings true to you?
It's a good question. Right, well, we'll get started. Hello and welcome to this afternoon's webinar, AAII Stock Superstars Report 2025 Portfolio Review, led by John Bajkowski. Thank you so much for joining us. We're happy to have you all here. My name is Jenna Brashear and I'll be your host for today. We appreciate you joining us for the final day of our Model Portfolio Review Week, where we'll be taking a look at the Stock Superstars Report. We also call that SSR, if I use that acronym. Each day this week, we had a lot of fun featuring a different AAII model portfolio. And if you attended an event earlier this week, you will receive an email next Tuesday with the recording, presentation slides, and a helpful resource doc that we put together. And then you can also find these materials published on AAII.com/webinars at that same time period. Before we begin, there are a few things I'd like to go over. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor and thus is not able to give personal advice. If you want to view our full disclaimer, please visit AAII.com/privacy/disclaimer. And then please keep an eye on your chat section throughout the webinar as I'll be sharing helpful resources and links that pertain to today's content. And if you have questions for our speaker during the presentation, please submit them using the question section of your GoToWebinar control panel. And then once our presentation concludes, I'll select a few for John to answer. If your question isn't selected during the broadcast, feel free to email us at members@aaii.com. Our presenter slide deck is available under the handout section of your GoToWebinar control panel, which should be located on the right-hand side of your screen. And it will also be emailed to all attendees. So please visit the GoToWebinar website for support at gotowebinar.com if you experience any issues with your audio or video during the webinar. I'll also put a helpful link in the chat as soon as John gets started. And in this webinar, John will cover a few things such as how legendary investors' strategies can guide smarter investing, the role diversification plays in achieving success in 2026 and beyond, and then insights into the SSR model portfolio's 2025 performance and 2026 outlook. And we have a special offer for today's attendees. This is the last day, so you can get a $50 discount on any new one-year subscription to an AAII premium product of your choice, including AAII Platinum, by visiting aaii.com/webinar-week and entering the promo code webinarweek50 at checkout. And we know that's a lot of information to digest, so please don't worry, I will add it to the chat momentarily so you can easily access. And with that, I'd like to hand over the presentation to John.
Well, thank you so much, Jen. I do really appreciate the effort you put in this week. You've done a great job of shepherding all of these reviews, and I think a wonderful job of giving us questions and encapsulating the kind of concerns that members have and questions members have. So hopefully you'll get some rest this weekend and give a chance for your voice to rest as well.
Well, thank you.
And again, thank you for attending our webinar as well to our members. I've been with the association since '87, and the notion of how does one learn from other investors, and how does one create actionable techniques and strategies is really what we're about, and the Stock Superstars report kind of encapsulates that. And today we'll be taking a look at how we came about with the Stock Superstars report, a look at its performance, and look at the individual performance of the strategies as well. And then Jenna will come back towards the end and take any questions. And Jenna, if any questions come up that need any kind of elaboration, if some complex concept comes up that people want some quick feedback on that would help with the presentation, please feel free to interrupt, and I'll do my best job of explaining that.
Sounds good. Will do.
Thank you. Thanks so much. So with that, really since I've been here, when I first started, we actually were using Apple IIs we're using a S&P product called StockFAB2 to run stock screens. But the whole notion of having a set of filters or parameters or things you use to pick attractive stocks and also determine what to sell has been instrumental to investing, really, whether you call it screening, whether you call it a technique, whatever it is. So here at the association, we've been tracking a wide array of approaches over time. We developed the software program, Stock Investor Pro. We developed it because really we wanted to offer products to members, but we couldn't get any kind of good discounts. No one was really serious about offering a well-priced stock screening system, so we developed our own. And we've been using that to illustrate different concepts. And we follow up in the journal, and we'll talk about the concept, the principles. You know, why should one look for a low PE, or what are the pros and cons of looking at price earnings ratios or growth rates and whatnot. We created 55 different strategies, and we track them on our website, and you can track them yourself. And we have performance as well. It helps us understand how these different strategies react over different points in time. And it's just the critical thing is you have a specific set of parameters that help guide your actions on the buy side and the sell side. So it's really, for us, it's been very instrumental and a great way of teaching how one goes about and what one looks for when it comes to successful approaches to investing. So this happens to be a screenshot from our new investor hub. It's a hub.aai.com, and like our main site, we have a section in here that has all of our AAI stock stream. And you can go ahead and favorite them as well. You can also favorite articles. In this case, you know, we've been covering many articles, and here are some of the, just if you happen to pull up the current issue of the journal, you'll find in there our review of the strategies that how they did last year. And in this case, the Ralph Wenger approach was the top performing approach last year. But you can go ahead and track these articles and learn about it, because it's not just a question of getting a list of stocks, but understanding why you want to have these kinds of stocks and what makes them attractive, and what kind of investor would these particular approaches be helpful for. But then you could also then go online. You can take a look at what the approaches are. Every day we present the list of passing companies. So as a member, you have access to that information. But then what we were getting from members was, okay, these are really great. They're helpful. You've got, you know, a wonderful number of strategies. How can you perhaps provide some additional guidance and perhaps create a product or newsletter or service that helps us follow some of these better approaches over time with more concrete rules as far as portfolio management? So that's what we did. And what we tried to do then, we figured, well, there's definitely benefit to having a mix of approaches, because at any given year, you might have an approach that's in fashion or out of fashion, and it's nice to get a couple of different approaches that are different in the sense of, even though they tend to pick good performing stocks over time, they might act a little bit differently in one year versus the next, or different market environments. Well, this happens to be this next two slides in your handout. They present all of our screens on our website. This happens to be data that we use to create our annual guide. It goes through mid-December last year. And a couple things I want to highlight. This is sorted based upon the risk-adjusted return. So those companies that have the highest return, but then we take into account the volatility. So what a risk-adjusted return does is it compares the volatility of that approach to that of the market. And if the volatility is higher than the market, it actually kind of reduces or levers down the rate of return of that portfolio versus how much it would cost you to use the margin rate. So it kind of penalizes you as far as borrowing. Or if your risk is lower than the market, it actually boosts your return on a risk-adjusted basis. But it's a nice way, because one way to boost return is simply to be more riskier when it comes to investing. So it's important to go ahead, I think, to use a risk-adjusted performance and also look long-term. And long-term, one of the best performing approaches that we have on our website is Titan, which is a kind of a micro cap approach that looks at price to sales ratio and price momentum. The thing about it is, it's interesting, is this approach, this table here gives you year by year performance. It gives you risk adjusted return, performance in bull and bear markets. These colored areas here are something we don't really do online too much, but it helps us to understand how these approaches interact with the market indices, and how different they are from each other. In fact, we'll run correlations like these against these approaches directly to help pick different strategies for the Stock Superstars report. finding those approaches that have good long-term performance, but tend to be different from each other. But the Cancelam approach here, which has a strong 14.8% return, risk-adjusted return over time from inception, only 9% of its long-term performance is attributed to that of the S&P 500. It really moves much differently than that of the S&P 500. So if you see a lot of green in these bar areas, that means that there's a higher correlation, a higher level of percentage explanation of that approach's performance with that particular index or benchmark. So if you see a lot of green, that means, like in this case, like the PE relative screen tends to move more like a large cap, S&P more mid cap, I guess, 79%, and tends to favor a little bit more on the growth side versus the value side. So it just helps us understand how these things differ over time. But we then basically took this information and we tried to pick those strategies that have good long-term track record, have a reasonable risk-adjusted return, are actionable, can actually are things that we could actually go ahead and invest in. And we have to build both buy and sell rules, because our hypothetical portfolios that we track online assume monthly turnover, which again is not really practicable as far as your actual portfolio is concerned. So with us, it was a question of creating 4 approaches. When we first launched Stock Superstars Report, we kind of kept the gurus or strategies kind of hidden over time. But then when we relaunched it, we revamped it back in 2020, we revealed the gurus behind it, and we made it more transparent as far as that was concerned. So we opened up, we created the ideas list. These are all features I'll be talking about as we go on today. And what you'll find in general with this handout that I have prepared for you, it's an open house. We have all members here attending. So I wanted to make sure I had some background information, probably more background information that we're going to touch upon during our presentation today. But it might be helpful for you to understand how these approaches, what drives them, how to use them, and give you some background and get some comfort level on, is this something you want to follow or track and whatnot. So our goal is to provide a diversification across styles and approaches. We have growth approaches, value approaches, momentum approaches, and whatnot in there. But they have to have good track record historically. And once we find that an approach starts to kind of lag the market consistently on a risk-adjusted basis, we kind of rotate that out. And we've done that over the years. And most recent approach we've added is the Bajkowski approach, which we added in 2020. As far as performance is concerned, last year was an interesting year. For the most part, we have 3 strong years where the S&P 500 outperformed mid caps and small caps, and for the most part, really growth, especially in the large cap arena, did better last year. Although in the mid cap and small cap arena, value actually started to shine a little bit, and we even saw with the shadow stock portfolio. I mean, it really went on did very well last year. I think last year was a year where we had a lot of transitions. It was not a smooth 17.9% gain for the S&P 500. We had the disruption regarding the tariff announcements. We had AI, artificial intelligence, going out of fashion. We had the Federal Reserve continuous easing. We had a government shutdown in there. And then we also had a rotation toward the end of the year, more towards some of the value names. And even now we're seeing even this year strong performance of some of the small caps, which we haven't seen in some time. So the point of, I guess, of this chart is that whichever segments you happen to invest in are going to be the ones that are going to kind of push your portfolio forward. And as far as the SSR approach itself, I mean, what we don't exclusively pick out specific sectors or industries, but what we find is that each approach tends to favor certain stocks at different points in time, certain categories at different points in time. Group 2 is the only approach that requires a dividend yield as part of its filter. Group 1 requires price momentum, earnings momentum. So this happens to be a breakdown of the sector concentrations within each group and of the portfolio as a whole. And along with that, we have the sector concentrations of the S&P 500, the mid cap, and the small cap. And we see, for example, information technology is the strongest segment, the strongest sector within the S&P 500. It makes up only 13% of the mid-cap index and 16% of the small-cap index. Within our overall portfolio, we have 3 stocks, 11.4% that are in the information technology area, and the biggest, most of them are, I guess, are found as a percentage of weighting, make up the impact of the Group 4, Group 3, and Group 1. Financials, which Group 2 has a focus more on deeper value, a attractive PE ratio, minimum dividend yield. That has a concentration in financials. So that one tends to be a little bit more heavily weighted in financials than the other strategies. So this helps to understand how does different approaches, what drives them, and what they did. As far as the performance of the portfolio, this year was a bit of a disappointment. The portfolio itself did 3.7%, which is more in line with, I guess, the typical stock, a little bit below the typical stock. And we had a big, last year was a pretty strong year. And last year, Group 1 was our driver. This year we had, with the rotation, the market really seemed to drive. We have a lot of big winners, a lot of big losers. That little rotation went on in the Group 1 approach this year, and that kind of pushed us down. Because the strategies in Stock Superstock Report, some have been in there since inception. Group 1 and Group 4 have been in the portfolio since the start. This chart displays not only the performance of the different strategies, but also what the AAII did that comparable period. So we see, for example, that Group 1 and Group 4, Group 1 since inception, its total return is 10.6%. Group 4NF, its total return is 10.8. AAII over that same time frame is 9.7. But last 2 years, especially last year, we've seen a little bit, I guess, reversion in that area as far as that's concerned. And large caps have done well, and we just have not really held up with that. Group 2 is a G-man approach, it's a more deep value approach. We added it back in 2006. And again, I think with the value that sort of softened its actually performance, they started to underperform the market over that last few years as well. Over its inception, since its inception, it's been 9.4% annual return versus 10.8 for the AAII. O'Shaughnessy, which we added in 2020, its return from its inception is 20.4, and it's been able to outperform AAII, even though it doesn't have a specific screen for small caps. Often it tends to find smaller cap issues that pass it, even though it's been a market where it tends to be very much value focused. So given that it was launched in an era where large cap growth really did well, its performance has actually been very strong, given that it's been sort of counter to what segments have been doing well in over time. This chart, this is just simply giving you a year-by-year breakdown of the performance of each group. And it shows you that, again, these things tend to run in streaks. And I guess the pro and con of having a diversified portfolio is that you perhaps don't always have a big winner any given year, but you hopefully are minimizing some of your losses during some of the down years. So typically when we have a down year, which is 2022, the portfolio was not down as much. But in 2022, which was the down year, you had that aggressive portfolio. Group 1 was down more than the market, whereas some of the more conservative portfolios, such as Group 4, kind of tempered that decline. So just the benefit of diversification in that context is helpful. And this gives us our typical our portfolio turnover over time, so people understand how active we are. So historically, on average, our portfolio turnover has been 40.8%, but that's kind of slightly boosted by some of the early years when we actually used to have 65 stocks, and we used to temper that down to now we have 40 stocks in there. So last year we had 17 buys and sells, and gives you a sense for how active we are as far as buying and selling things. When it comes to explaining the approaches, I thought it would be helpful to really perhaps talk about some of the holdings that are in each approach. And I'll be talking about, we have 4 approaches. I'll talk about them one at a time. And I'll provide a little bit of color on the specific quantities or factors or qualities that are used to both buy and sell these approaches. And then the slides here will have some additional background for you that you want to study on. You can go ahead and read on your own, and also online if you're a member of the SSR report. You can, of course, we have a lot of online help and guidance that give you information on what that is. But we have 4 strategies. William O'Neill approach is group 1, the cancel approach, and very much kind of a earnings price momentum approach. David Dreeman, longtime value investor, contrarian investor, which takes not only takes the deep value approach, but also adds to it a earnings revision twist. And then James O'Shaughnessy approach, which is a multi-factor value approach, which adds in earnings quality and financial quality to it. Make sure you have not only, just hopefully you're avoiding some of the companies that deserve to trade with a low price that are value traps. And then John Neff, kind of a total return approach, a growth at a reasonable price approach that, again, they're all interesting. They all are based upon screens we have online, and I found them to be really helpful, and they complement each other very well as far as helping to indicate or provide some interesting ideas, but also tend to move a little bit differently than others do. So the William O'Neill approach, and the approach has changed over time. We first started tracking it here in the 2nd edition of How to Make Money in Stocks. There have been subsequent editions that kind of revise some of the factors or queries over time. But our current portfolio in this happens to be a screenshot from our website, and it seems to be a slight bug that was not providing the prices for these particular holdings that are in there right now. Right now, each approach has 10 stocks that are in there. And normally speaking, when a stock is removed from a group, we then add a stock of that same approach back into it. With SSR, we normally do our weekly updates on Friday. We'll be sending out an update today that is a recap of the performance for December. And then, we will typically rotate through the approaches and do a deep dive on whether or not there's any valuation concerns or perhaps some other concerns as far as relative price strength. We'll examine the ideas list. These are fresh ideas or candidates to consider, and we'll make any kind of transactions as necessary on a consistent basis. So what William O'Neill did is he basically took a look at a group of stocks that had really great performance, and then he went back to what kind of characteristics did these stocks have before their big stock price run up. And if I look for these characteristics today, these perhaps will be stocks to consider for the future. We'll have browse winners to look for these candidates today. And what he found is that typically speaking, stocks that went on to have good, strong performance, they already had a good track record of quarterly earnings growth, year-over-year growth, a consistent year-over-year increase in earnings. They were hitting new highs. They had strong relative strength. They had institutional support, and they had some sort of catalyst that helped attract attention, the institutional following in there. So let's take a look. Let's just pick one of these stocks here. Let's see. Well, Build-A-Bear up there. Let's talk about Build-A-Bear for a second. This was added back in July of this year. It is in the consumer discretionary area. It happens to have trading at a price as a percent 52-week high of 87%. So this is a filter like stocks, how close they are to their high. When the market is hitting new highs, it won't be very restrictive. Most stocks will be near the high. If you're kind of hitting a market downturn and there are very few stocks hitting new highs, this becomes a very, very strict filter. And in order to be added to the portfolio, we look for stocks that are really within 10% of the 52-week high when they get added. Also, we look for stocks that are outperforming the market as a whole, that people are following them. So, in the case of Build-A-Bear, it's got a relative strength 52-week average of 74% and rank, so it outperformed 74% of all stocks over the last 52 weeks. And to be added to the cancel approach, the group 1 approach, has to have a relative strength rank of 70% or better. And the other factor that he found, this case, Build-A-Bear actually last quarter reported a downturn in quarter-over-quarter growth. So now it's kind of we're watching it now, see if it bounces back. If we have subsequent quarters of down quarter-over-quarter negative growth, that would be a candidate for removal. But what William O'Neill found was basically these companies are, when you add to them, when you look at them, we're growing quarter-over-quarter. They already had that high growth. In the case of Boyd Gaming, it has NA for year-over-year quarterly growth. That's because it actually sold off. They had it online. It's a gaming company, gambling company. They had an interest in an online gaming company, which they sold off, and it actually generated such a high level of earnings that the year-over-year earnings growth is not meaningful comparison. But we want to look for at least 20%, and we want to have that latest quarter to be greater than the quarter before. And a lot of these have high annual earnings growth, but we found that screening for just high levels of annual earnings growth is not a good strategy to pick winning stocks. You're better off looking for consistency. And that's, I think, what sets apart the CANSOM approach from just a high growth approach. Even though they all have high growth, historically speaking, look at these 35% annual growth rate in earnings last 5 years. But they all have had, at least, in this case, at least 4 years of continuous growth where every year's earnings are higher than the previous. So it's that consistency, I think, is a valuable factor, more important to find out quality stocks than just simply looking for high levels of growth. You'll find if you just screen for high levels of growth, either forecasted or historical, often those companies go on to disappoint because that growth is already priced into it, or you have reversion to the mean. So this is how, I guess, Group 1 approach is sort of the genesis of what kind of stocks meet that group. And when it comes to selling, we look at price momentum and also declining earnings. And this group tends to have the greatest amount of really buys and sells because of its price function. None of the other ones have quite that strong price momentum factor. So last year was a down year for this approach. It had some tremendous winnings. Wilden Group, which was added during the course of the year, is the rate of return we had while it was in the portfolio, 103%, very, very strong. But the trouble we found, I guess, with this particular approach over the course of last year was like a odd year in that a lot of, I guess, whiplash almost, a lot of rotation that occurred over the course of the year, and all of a sudden investor sentiment shifted, and the stock that passed this momentum approach, 1 quarter, all of a sudden were out of favor the next quarter, and it was got much more rotation than we normally experience in the past. That really hurt the performance of this approach last year. But just to read this chart, just to give a quick rundown, return on investment, that is the return on investment while it was in the portfolio. And I thought last year we had the weight at the end of the year, but I thought this will also give you a sense, just to remove the mood over the course of the year. It also provided the weight at the beginning of the year, just to give a sense for, people were asking, well, how come the stock had a great performance? Well, why is this end of year weight still relatively small? Well, it might have been very small at the beginning of the year. This gives you a sense for also how much the weight is of the overall strategy as well. So at the end of the year, Group 1 approach was 19.3% of the overall weight of the SSR model portfolio that we have. And your approach may be different than ours. But just how to interpret this particular page and printout. And when it comes to Group 1, every approach, we generate watch lists, ideas list. Almost watch list almost sounds negative. How would you change that term to something? Ideas list, perhaps. But these are what we draw upon for candidates. And it's interesting because this is Group 1 tends to be very dynamic, very much what's popular now. We're seeing interesting broker, Carpenter Technologies, which is a holding. So it's this would be where we would basically, this is our pool of adding new candidates to the approach, and what's in there. So again, this is our most volatile approach as far as volatility. Also has the highest turnover, but long-term great performance. But it will have, it's a kind of swing for the fences type approach, where you will also have quite a bit of strikeouts along the way. The Dreamer approach, he's a well-known contrarian and really provide a lot of good research when it comes to doing any kind of analysis of estimates. Helps to understand that when it comes to being a contrarian, you don't necessarily want to buy the cheapest PE stock, but you want to buy stocks that are attractively priced. But it's also important to have financially sound stocks, and he was like to have a little bit of dividend in there to kind of provide some financial strength and help provide some clarity as to the company's fortunes. And the other thing I think was that he found that earnings estimates were more meaningful, earnings surprises were more meaningful to value stocks than growth stocks. When it comes to growth stocks, people expect you to beat earnings, and disappointment is when you don't actually beat by a higher margin as you perhaps should. When it comes to value stocks or beaten down stocks, people don't expect you to do well. So any kind of positive earnings surprise is taken as a reassessment of your ability, and is a much more meaningful element. So when it comes to the group 2 factors, what we look for are things such as the price earnings ratio. But we look for stocks that are simply in the lower 40th percentile stocks, not the cheapest PE ratios, because a lot of stocks that have really bad or low PE ratios deserve to have low PE ratios. We look for stocks that are at least mid-cap in size, because Dreaman believed that companies that were larger had the resources to bounce back and the visibility to bounce back. If they did all of a sudden bounce back and did well, the market would really push their stock prices up. Look at things such as earnings revisions, earnings surprises. Did they actually have a positive surprise? Are their financials strong? And when it comes to financials, when it comes to certain ratios, it's important that you consider whether or not they're industry specific. So in the case of, in this case, we're looking at total liabilities to assets. A company that is in a more stable sector industry, such as perhaps say utilities, they typically will have the ability to service a higher concentration of debt than a company that has more volatile earnings. You don't typically have a lot of debt. Interestingly, it's happening now. You don't typically have a lot of debt in software companies traditionally. That's all changing now with AI. A lot of these companies are taking out a lot of debt to fund their AI research. So that'll be interesting to see if earnings actually come with that. So yeah, with the Dreaman approach, you're looking for stocks that are attractively priced, have had recent positive earnings surprises, have solid growth, are paying a minimum dividend of 1% or higher. They're larger, more stable, and good margins against the norms, and actually attractive levels of debt or low debt relative to their peers as well. So it's a when it comes to selling, the typical reason we would sell a stock in group 2 is because its PE has gotten too high. It's cut its dividend, its financials have gotten poor, or it's gotten in the case of relative strength, we always have an overall relative strength rule of this portfolio. Dreaman like to look at kind of a 2-year period, because if you bought a stock and it's doing okay, but it's not really hitting it out of the park, after 2 years, reevaluate, see if there's better candidates out there. If it's underperforming the market of 2 years, maybe it's time to jettison and find a candidate that actually meets the approach. So performance-wise, 3.3% this year. As you see, it held much fewer stocks over the course of the year. And again, I think JP Morgan was one of the top performing stocks in Group 2 last year. Here it is, a top performing stock this year. And one of our oldest holdings, if not the oldest holdings. So members often ask, should I buy the newest holdings? Should I buy, if they're buying a section of them, is there a risk of buying holding? Really, I think the issue is not so much how long it's been in the portfolio, but does it still kind of meet the characteristics, the spirit of the screen when it comes to why you want to buy and sell it. So, in this case, JP Morgan, one of our oldest holdings, still very financially strong. In fact, I guess we'll be announcing earnings next week, so we'll see how it reports. But financials did well last year in an environment of declining interest rates. We just added Walt Disney last year. So, again, it's typically larger companies that are a little bit better known. They can be contrarian. In the case of Miller Coors, suffered last year with decline in people drinking alcoholic beverages. Also, there's issues as far as some of the costs that go into that. And Owens Corning, a maker of insulation and garage doors and whatnot for homes, suffered from a tariff issues as well as overall some weakness in the overall housing market as well. So, but it's as far as what's passing now, we're seeing a lot of banks pass Group 2 right now. And again, we mentioned a lot of banks are within this portfolio currently. So, but banks, see some looks like a healthcare company or two, even a mutual fund company, Janus is passing here as well. So interesting set of companies that are passing here, and we go ahead and look for some candidates. I'm sure we'll find something interesting to pick from here. Our newest approach is the O'Shaughnessy Group 3 approach. And if you are, of course, a follower of our stock screen online, you'll see there's probably almost maybe 6 or 7 different strategies that are available. This is those are based upon some of the earlier works of James O'Shaughnessy. This was based upon his most recent work, where he found that there was an advantage to really actually going past single factor approaches. Single factor approach that he used in his first strategies and what the Tiny Titans is, where it just looks at one factor, primary factor to pick which stocks to buy. Give you really the big home runs, but if you want consistency over time, found it better to really create a composite score for value. That this will give you better, consistent, attractive opportunities to invest in over time. So the Group 3 approach relies on the value score, the value grade, which combines and looks at things like price to book, price to free cash flow, PE ratio, price to sales, EBITDA, enterprise value, EBITDA, even shareholder yield, which combines both the buyback of shares as well as dividend yields, and make sure that any stocks that pass also have a high level of financial strength. This is our current holdings. It's ranked based upon the value score, and right now, again, you buy these stocks, you hold them until their financials deteriorate or they are no longer of value. And Warrior Met Coal, which has really done very well in our portfolio, it's bought it at $11.39, and it's now close to $100. It's now actually has its value score in that it's sitting. That's the sell range at 18. So if it's still at that level, when it comes to our next portfolio review, it might actually be a candidate for sale. They mine metallurgical coal. They used to make steel, and domestic company. So a lot of they've done actually very well. And looking at the performance, here we go. Yeah, it's one of our better performing. It's 63% last year. I think it was one of our better performing holdings last year as well. And then some of the ones that didn't do well this year include Upland Software, which and a healthcare company, Intergen. So again, this as a group, I think it was our best performing group last year, 8.3%, and it is makes up 30% of our overall holdings. So often it's funny, actually, these names are starting to become a little bit more well known, but often stocks that are passing this approach are a lot of them are names you don't really hear of too often. I mean, for a while there, I guess we had American Airlines passing. I see Group 3 Apparel, which I think is might be in the VMQ approach as well as shadow stock. But often, actually, what I find interesting here is actually this is the Group 3 ideas list, but actually Molson Coors, which is held in Group 2, currently passes this approach right now. So this is our ideas list, but it's a nice quantitative approach to investing. So we basically buy when they're cheap and earnings quality is high and financial strength is high, and then we sell when the value no longer is there or if the financial quality deteriorates. And then the last approach that we have is the John Neff approach, and longtime manager of the Vanguard Wizard Fund, and back when Vanguard was known more for its actively managed funds as opposed to index funds. But he wrote a book during the great growth era of the 1990s, and was thought that people had sort of forgotten about some of the principles of how one invests in companies, and the basic quantitative factor, the primary quantitative factor that's used to buy and sell, add and remove stocks from the Group 4 approach is the PEG ratio. A very simple number on the surface. It's just simply at its most basic level, it's the price earnings ratio divided by the earnings growth. And you could vary that quite a bit. You could use trailing earnings, you could look at forward earnings, you could use historical earnings growth, you could use future earnings growth. And a lot of people like to add in a dividend component to that growth. So you actually do the price earnings ratio, and you would divide it by the sum of the earnings growth plus the yield. So it's the dividend adjusted PEG ratio. And what makes you typically buy when the PEG ratio is low, which means the PE ratio is low relative to earnings. And this is sort of a relative comparison. Again, you could support a higher PE ratio as long as earnings are high to support that. So you don't mind investing in a higher PE stock if it has that growth potential. That's a way to kind of go beyond just simply low PE, which is an absolute number, to really a PE relative to some other variable. And what we find with we use PE ratio in Group 2 or PE ratio in Group 4 is often it's best to look at it in some relative context, how it compares to others, either itself or against other companies. And so this happens to be sorted based upon the PE to dividend adjusted estimated growth PEG ratio. So the PEG ratio we use for the NEF approach is the trailing PE, and it's divided by the long-term estimated growth rate plus the dividend yield. The thing we've been struggling with lately, I think, and we have a couple of stocks here that actually have NA for that dividend adjusted PEG ratio, is that lately we've seen fewer and fewer analysts willing to actually produce long-term earnings growth estimates. So all these companies had PEG ratios when they're added to the portfolio, but now some analysts are not actually providing, even for Pulte, a well-known home builder, they're not comfortable enough to give a long 3 to 5 year growth estimate in earnings. When that happens, we then kind of rely upon a historical earnings growth to determine if it's perhaps time to sell, or we'll look at the progression of earnings estimates over time. Historical last year to the estimated current year versus the estimated next year to get a sense for what kind of growth is expected near term. So the company right now, Cencora, has the highest PEG ratio, 4.27. And I believe when I did the analysis, looking at them yesterday, I want to say that the overall median was somewhere around 2. It actually would put the company in the sell range. So we'll have to do a review next time. It's quite possible, and this has been a strong performing stock, even though it has had good earnings growth historically, and its estimated future growth rate of earnings is still strong, 9.2. Doesn't pay much of a yield, I don't believe it down here. But again, it's attractive valuation, it's positive cash flow. Is the company have strong operating margin relative to the industry? Because operating margin by itself, you have to compare against the industry for it to be meaningful. And the same is true of debt. So does it have the good financials? Does it have some competitive advantage, perhaps as represented by the operating margin? These are things we find in successful screening strategies, and it's part of the NEF approach. We typically, sell stocks in the NEF approach because of deteriorating fundamentals. In the case of operating margin declining relative to peers, all of a sudden earnings are declining and the PEG ratio rises. Those are things that are relative underperformance as well. So really, it's the things that drive the purchase also drive the sale. But the level, like when we buy a stock, we add a stock to Group 4, we look for that PEG ratio to be half of the overall market median, but we let it go 2 times that median when it comes to actually selling it. So we mentioned here that Cencora was up 51% last year, and again had a pretty good performance last year as well. And in that context, it's getting to be kind of perhaps a little bit rich for this particular portfolio. So when we do our portfolio comparison, our portfolio review, it's under watch right now as far as that's concerned. And watch list wise, I actually had just a partial list of the companies that are passing currently. A ton of companies are passing, a lot of financials, a number of home builders are passing right now. So it's interesting as far as what is particular passing in this approach right now. Give you a sense for what's being currently attracted. And this happens to be ranked by the PE dividend adjusted PEG ratio. So when it comes to stock superstar, it's really we think it's any investor with a systematic approach who has outperformed the market over the long term. That's what we look for our stock superstars approach. And we don't pick one approach because we don't know which approach will do best in any given market, like the diversification they have across 4 approaches. But we will actually rotate approaches out once they happen to have a underperformance on a risk-adjusted basis. But it's I think the important part for successful investing, and hopefully you've probably heard this theme all week, is that discipline is key. It's important to have an approach you believe in, to follow it, to have a framework. It's always more difficult to sell stocks than it is to buy stocks. I think that's one of the reasons why, as investors, long-term, we underperform the market, is when you don't really follow a disciplined approach to investing. So hopefully I've provided you a little bit of food for discussion, and I've left some time for Q&A. So thank you so much, and I'm sure that perhaps Jenna may have some announcements to make, but take it away, Jenna.
Yeah, thank you so much, John. So I just wanted to reiterate before we go into Q&A, I appreciate everyone for submitting their questions. Feel free to keep submitting them as we go along. But before we get into the Q&A, I do want to just share that if you visit AAII.com/webinar-week or webinar-week, you can get $50 off any one new 1-year subscription. You can subscribe to Dividend Investing, Growth Investing, Stock Superstars Report, BMQ, and even AAII Platinum, which is our bundled service. Just simply visit, like I said, AAII.com/webinar-week, and then use the promo code webinar-week50 at checkout. And this deal expires January 12th at midnight Central Time. And I'll put that in the chat as well, so you have that handy. But let me go into Q&A. So let's see. For the first question I wanted to ask you, John, and I asked you on Monday, and then I forgot on Wednesday, and you reminded me. But what is one thing that surprised you about the SSR portfolio or one of the gurus this year?
I guess for me, the biggest surprise that I perhaps even touched upon in my presentation was really how the market really kept rotating in terms of what it found desirable over the course of the year. We went into the year with a lot of expectations, with a president that we thought would be very, would typically and historically has used the stock market as a gauge of success. So when the tariffs were announced and they were much steeper and more restrictive than anticipated, and the market had a big free fall for a lot of volatility over the last 2 months. It's kind of surprising that people didn't think he would let it happen. In fact, perhaps it was the bond market that helped him change that. But over the course of the year, I mean, it was everything kept rotating, and even the year ended with a different set of expectations. AI was strong throughout, which it has been last 2 years. But as the year went on, and approaches that seemed sound, everyone thought that it was important to be invested in AI and important to be invested in stocks that had a strong domestic manufacturing base. And one of our holdings within, I think it was Group 1, they did a navigational add-ons for the F-16 fighters, and they were all based in the U.S. But and they were well positioned, but all of a sudden they fell out of favor very quickly, and they were sold. So for me, it was the rotation that occurred, and how people's perceptions changed quickly. I guess that shouldn't be a surprise because we always are surprised, but it was quite a year.
Yeah.
A lot happened, even though it was relatively, even December performance was like close to zero, but a lot of churn underneath the waves.
That's very true. That's very true. And let's see what else we have. We've got quite a few questions. We'll start with, let's see. Okay, so one of just a logistical question. So we talked about the watch lists a lot. And then in previous webinars this week, we talked about ideas lists. So do the watch lists on each portfolio act similarly to the ideas list on other AI portfolios, or are they different?
Yeah, they are. Terminology wise, I guess you could almost do interchangeably. They are ideas lists in the sense that you're right. The word watch list is almost makes it seem negative, but it is an ideas list, and it is the pool of securities we consider when it comes to adding stocks to the portfolio.
Excellent. And so a lot of people were talking about either, we have a lot of SSR subscribers who are focused on the model portfolio. And then we also have a lot of subscribers who are focused on the stock screen. So each of the gurus, Dremin, Neff, O'Neill, O'Shaughnessy, all have stock screens based off their strategies. So if someone was just getting started, should they follow one of those, or specifically the SSR model portfolio? What are the pros and cons of choosing one or the other?
Sure. Well, yeah. The stock screens that we have on our website, I think, are a great idea generator. What you have to do then is you have to understand is that when a stock passes a screen on our website, that's sort of like kind of a buy range for a stock. The part that you have to then maintain on your own, which is, if that's what you really want to do, which is great, is, you're gonna have to determine, because stocks fall off our stock screen list online if they longer pass. But often you typically want to hold the stock for a little while and let it run up. Like in the case of like a PEG ratio, you may want to buy a stock with a PEG ratio that's half of 0.5, but you may want to sell it when that PEG ratio maybe hits 1.5 or 2. So you have to then monitor that PEG ratio on your own, which, if that's something you want to do, you're more than welcome to do that. What we try to do with Stock Superstars Report is provide you that guidance and understanding of, how one manages the portfolio from start to finish. So, what are the factors you should consider for this type of style of investing for buying, and what will be the factors that would make you want to sell that stock? And it could be positive, it could be negative. I hate to let go of stocks that have done well, because they're no longer attractive. But I also love that factor. It's great to have a stock that's gone up, sixfold because of its longer attractive value, and try to find the next one that's going to be sixfold increase. So it's important to have a set of rules to help guide you on the buy side and the sell side. So, yes, the stock ideas are a great tool to find those ideas, but then you have to add on to that some system for managing those, for building a portfolio, for tracking the news and determining when you want to sell them. And we try to do all of that within the SSR system and educate you along the way to give you the confidence you need to do it on your own as well.
That's a great answer. And we have a couple retirees that ask similar questions. So are there, and you might have actually touched on it a little bit in each when you were talking about the strategy, but are there different risk profiles associated with each different guru? And is SSR as a whole, a bit risky for retirees, or is what is your kind of suggestion on that?
Yeah, well, I'll take it. I'll ignore the retiree part because it's always tough because with a retiree, it very much depends upon how much you have in assets, and whether or not you're actually saving not only for yourself but perhaps for your heirs. So I don't know what your time horizon will be, but a more direct way to answer that perhaps is that yes, and we I guess I'll have to add that slide next time, but we track the volatility of each of the screens. So group one, which is focused on price momentum, earnings momentum, is going to have the greatest number of transactions that occur on a year-to-year basis. It's also going to be the most volatile, and it's not going to have any income component. Group 2, on the other hand, it has a requirement for dividend yield, only 1%, but has some dividend requirement. It's going to be more stable than Group 1. So you're going to have a lot less turnover in Group 2, and you're going to have a little bit less volatility than you would in Group 1. Now, what we try to do as a whole, what we'll find is that if you combine all 4 approaches, the combination of 4 will have less volatility than any one single approach. That is, we statistically that actually happened. We watched that and we tested. We actually the overall volatility of the portfolio as a whole is less than in the individual component. But you could also even go further and simply cherry pick an approach like Group 1 if you wanted to. That would be really more focused on dividend, have a dividend component and focused on value.
That's excellent. And let's see. This is kind of an interesting question. I'm not sure. Yeah, this is. I don't know if we've got something quite like this, but this is more just talking about. Yeah. Let's see. This deals with stock screens. So, have any stock screens shown to consistently identify underperformers suitable for short selling? Do we have any stock screens that do that?
That's a good question. Yeah. We don't. Well, it's funny. Every year is different. Normally speaking, we have earnings estimates up, earnings revisions up, earnings revisions down. And normally speaking, and long-term wise, the earnings estimate revision down has been one of the weakest performing strategies out there. But last year it was among the top performing strategies. So it's sort of a challenge. This happens to be like we see like earnings revisions down 30%. I mean, long-term wise, its rate of return is close to 0, and risk adjusted it's actually worse. But last year it was up 50.6%. So I mean, it's like you would think that okay, yeah, that would be an approach that you think might be good for short selling. I mean, our insiders net purchase strategy, we thought that would be an interesting approach. We simply are looking at insiders, company insiders that are buying stocks recently. But we put a small cap filter in there, and it's been a terrible performing strategy. But I guess we have not taken these and created, I guess, inverses of them to highlight super expensive stocks. The only one I guess that we know for sure is sort of meant to be negative is this estimate revision down. But again, last year was an outlier, and I think maybe because the year itself was such an odd year as far as people's expectations changing over the course of the year. That's how I think that one does well odd in periods of economic transition. I think it did really well, I think in 2009 and 2001.
Interesting. I like that question. Let's see.
And this is actually this provides the risk index.
There we go.
So like Group 1 has a risk index of the last 3 years from inception of 1.3. A risk index of 1 indicates the risk the same as that of the market. So in this context, a 1.8 over the last 3 years means it's about 88% more volatile than the market. The Group 2 had the lowest risk index last 3 years, 1.38. But if you look at the overall market, the overall risk index for SSR is 1.29, which is lower than any of these individual risk component scores. So that's sort of the concept of diversification, is that they're all moving a little bit differently. So when they combine themselves, you should have a less volatile approach than any single approach would have on its own.
That's a good example. Let's see. I'll just pick one more since we're kind of approaching that 2 p.m. mark. Again, if we did not get to your question and you would like an answer, please email us at members@aaii.com. Let's see, we'll do one more. This is kind of interesting. Would you ever consider adding a new guru to the portfolio, or is there a specific reason why you usually stick to the 4 gurus? Is that a sweet spot?
Yeah, It is, my fear is adding a fifth would all of a sudden just, four is a lot in and of itself. And in that context, we're displaying information on 40 stocks, which is a lot for people to kind of keep track of as a whole. You know, much beyond four, I mean, you start to get into the whole notion of, are you actually just mirroring the marketplace? One thing that has changed, and I'm wondering if it was one thing we used to do prior to 2020 was that we didn't necessarily, if we sold the stock in group one, wouldn't necessarily replace it with the stock in group one. We simply replace it with the next stock up, the next guru up. So we actually had a uneven number of stocks across approaches. But we had some feedback from members and they preferred to have a one-for-one replacement. But then adding a fifth, you know, I'm afraid it'd be perhaps get too much for people to follow. I think just, you know, it's just, even they talk about, you know, grocery stores, you know, you see, you can make an easy choice if you have, you know, 2 or 3 toothpaste to pick from. When you have 20 toothpaste to pick from, I don't know which one to pick. So you kind of break out.
I do that too. No, that makes a lot of sense. First off, I want to say thank you so much, John, for not only answering all of our questions today and going through such a great presentation of the SSR portfolio, but also wrapping up our final presentation of the week. You presented on Monday, Wednesday, and now today, so I really appreciate your involvement, and I know our subscribers do as well. But I did, before we move into all the nitty gritty, all the good stuff I have, last minute information, I do want to offer you just a minute if you wanted to leave our audience with any last thoughts or comments.
No. Again, I perhaps I've said this before, but if I haven't, I just want to thank everybody for being a supporter of the American Association of Individual Investors. It's great to be part of this community of people who care about themselves, their education, who want to better themselves, who want to take control of their financials, and you know, we're all in the same boat. We all want to become better investors, want to make a better life for ourselves and our families. And you know, what a better way, what a better hobby to have. If you want to call it a hobby or a love or whatever, of making yourself better in investing, and being able then to pass on this information to your loved ones and your friends, and share this information with the wonderful community. So, you know, whether you share with your friends, if you get involved in our local chapters, however you want to express yourself. So thank you so much for getting involved with us, and it's been a wonderful experience. And I'm sure if you're like me, you enjoy reading about these approaches and finding one that works for you, so that you can sleep well at night. So that's the key to life, is just being able to control your destiny and sleep well at night. So thank you so much for tuning in.
Couldn't agree more. And if you have questions about the SSR portfolio, its performance, holdings, etc., or if you just have questions about your AAII member benefits or anything else, please feel free to email us at members@aaii.com. That is the best way to reach us. And just to clarify, Stock Superstars report, also referred to as SSR, is a premium subscription, but it is also part of our AAII Platinum service, which is our bundled subscription. And until January 12th at midnight Central Time, you can use the promo code WebinarWeek50 at checkout to get $50 off any new 1-year subscription to an AAII premium product of your choice, including SSR and AAII Platinum. Please visit AAII.com/webinar-week to claim this exclusive offer. And I just want to say thank you so much to our presenters this week, John, Cynthia, and Charles, for taking the time out of their day to walk through each model portfolio, highlighting what worked, the challenges that they face, the allocation of each portfolio, its overall strategy, and more. So I really appreciate their time. And this was a really fun week for that, that our team and I look forward to each year. We have an exciting year of webinars planned for 2026, aside of our model portfolio review week. So we do hope you join us for our next event. You can find all of our upcoming events posted at AAII.com/webinars. And then we typically post them 2 weeks before the event occurs. And lastly, this presentation was recorded and a replay will be available next week at AAII.com/webinars. And webinar attendees will receive an email with a link to today's recording early next week. And in that email, you'll also receive a copy of our presenter slides, as well as links to other resources that we discussed or that I put in the chat. And then if you're an AAII member, we hope you take some time this week or next to explore the new AAII Investor Hub and redesign My Portfolio Plus. John walked through that in the very beginning of his presentation, but we are really proud of what we've created over the last several months, and we hope it helps you with your stock research and analysis. And if you want to explore either of those features, you can visit hub.aaii.com and enter your AAII member credentials to log in. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you so much and take care.